Bank of America just issued a dire economic warning. They're saying that Americans have stopped spending, showing that total card spending per household has now dropped minus 1.2%, with the biggest drops in spending coming in furniture, luxury fashion, home improvement, clothing, lodging, and housing-related services. And what's concerning here, folks, is that 70% of America's GDP comes from consumer spending. So if consumer spending is declining, our economy is declining, and we're in recession, and very shortly, we're likely to have a big surge in layoffs and an increase in unemployment. In fact, Bank of America is saying that surge in unemployment is already occurring for wealthy people, reporting that unemployment is rising fastest among higher income households. In particular, there's been a 40% increase in high income households receiving unemployment benefits through their Bank of America direct deposit. And so this recession is a white collar recession thus far. It's been wealthy tech workers, it's been wealthy people in finance and business who have bore the brunt of the layoffs for companies like Microsoft and Google and Meta and Disney. But what concerns me is that as these layoffs continue and as consumer spending continues to decline, we're going to see the economic contraction spread, because the same report from Bank of America shows that over 60% of consumer spending in America comes from higher income households. And so what's going to happen, everyone, as wealthy people continue to lose their jobs and spend less money? Well, that's going to have a trickle-down effect to all the other portions of the economy since they spend so much money. In particular, I think we're going to see restaurants start to get impacted in the second half of 2023. We're going to see hotels. We're also going to see Airbnb owners start to struggle, because someone going and staying in an Airbnb is a super discretionary decision that's going to face big cutbacks during a recession. And in fact, Airbnb, the company, is already predicting these cutbacks. Their stock tumbled last week after they gave a muted travel outlook for the rest of 2023. In particular, they noted that travel demand in North America is weaker than in other markets because of rising costs. The result was that Airbnb's stock price collapsed by 15% over the last 5 days. And a slowdown in Airbnb has very interesting implications for not only the economy, but the housing market. Because according to AirDNA, there's 1.35 million listings on both Airbnb and Vrbo, up 20% year over year. Those 1.4 million listings on Airbnb are more than double the total inventory on the US housing market right now. And so conceivably, if some of these Airbnb owners start to struggle and make less money, we could see a lot of these Airbnb owners be forced to sell, specifically in certain cities. With AirDNA showing that occupancy rates for short-term rentals have gone down the most year over year in Cape Coral, Oakland, Portland, Philadelphia, San Antonio, Miami, Fort Walton Beach, Dallas, Denver, San Jose, Austin, Seattle, Fort Lauderdale, Minneapolis, Phoenix, Santa Rosa, and the Coachella Valley. And ultimately, all those Airbnbs are part of the huge amount of what I call shadow inventory on the US housing market. And by shadow inventory, I mean the millions and millions of homes that are owned by people and just sit vacant or get occasional use for something like an Airbnb. And you can see, according to the US Census Bureau, we got lots of shadow inventory. Of the 97 million single-family homes that are owned in America, 12 million are classified as vacant by the US Census Bureau. These are homes that are owned by wealthy people as second or third homes. They're owned by investors and held off the market. There's 12 million of those compared to the 600,000 of homes listed for sale. So think about this, everyone. Vacant shadow inventory of 12 million is 18 times the active inventory listed for sale. And so it's very important for you all to remember, particularly if you're a frustrated home buyer out there trying to make sense of how, inventory is still low on the housing market and prices are still high. Understand that there's no actual structural shortage of houses in America. There are plenty of homes to go around for everyone who wants to buy a house and rent a house. Rather, we have what I call a cyclical shortage of homes available on the market because of multiple years of government intervention in the housing market. Whether it was the Fed artificially suppressing interest rates and causing a huge surge of people to buy second homes during the pandemic, or the US government blocking nearly 2 million foreclosures from occurring during the pandemic, all of these things worked to suppress the active inventory. And as we move further and further away from all that government intervention, and particularly move further into this recession, where people start to lose their jobs because of less consumer spending and more layoffs, we're gonna see more people be forced to sell their house rather than just sit back and say, I don't want to sell. But I know a lot of you are kind of fatigued by all this recession talk. You've heard about it for a year. You haven't been able to find a house that's cheap enough yet, and you're getting frustrated by it. But guys, I would really encourage you to stay strong and understand that the fundamentals we're seeing in the economy right now aren't good, and that now is not a good time to buy a house. I mean, just think about the two warnings I talked about so far in this video from Bank of America and Airbnb. They're issuing these warnings saying things are getting worse. Those are two massive companies. In addition, J.B. Hunt, the largest trucking company in America, just said that we're in a freight recession, reporting that revenue in their freight trucking division was down 42% year over year, with load volume falling 26%. And so that's concerning, everyone. The trucking industry is one of the best bellwethers for the health of the US economy, and they're saying, whoa, we're experiencing big problems. People aren't shipping as many goods. And ultimately, that ties back to consumer spending. Why are there less goods being shipped on trucks? Because fewer people are buying goods. A reality that's now being felt by lots of small businesses across America. In particular, small businesses are reporting their worst economic confidence in decades, with the NFIB's Small Business Optimism Index crashing to a level of 89 in the most recent survey. You can see that's basically the lowest level in a decade, with data from Paychex showing that small businesses are struggling the most in metros like San Diego, Riverside, San Francisco, Denver, Seattle, and LA. This is where small businesses are cutting back employment the most. Ultimately, the real problem I see in the US economy that I think is going to inevitably produce big layoffs and big declines in home prices and stock prices is a monetary problem. It's the fact that there's just simply not enough money in the system and growing in the system to sustain the sky-high prices that inflation has delivered us in America over the last 2 to 3 years. And there's not enough money in the system in two ways. The first is wages. You can see that worker wage growth in America after peaking in early 2021 has now decelerated to 3.9% year over year. Now that wage growth is still above the long-term average of 3%. However, it's not high enough, because you can see that the orange line, inflation, has now outpaced wage growth for almost the last 2 years. And inflation, yeah, it's come down. It's staying stubbornly high at 5% year over year. I think it's going to come down more in the future, but so long as inflation is above wage growth, this economy, it doesn't have a chance of recovery, because that's where the rubber meets the road. Income and wages and pay growth. If people are earning more money and enough money to afford their necessities and discretionary spending, then the economy can keep going. We could conceivably avoid a recession if the wage growth in America were to do a U-turn and start going up again. But more and more, it appears like that is not going to happen, with the data from Bank of America confirming a similar trend. They show that after-tax wage and salary growth has decelerated for all income groups, and for the highest income group, it's actually negative. Wage growth is now negative for those making over $125,000, and it's barely above 2% for those making less than $125,000. And so people are still struggling out there, which is one reason maybe why consumer sentiment in America is so bad. The University of Michigan Consumer Sentiment Survey just showed that consumer sentiment crashed down in May. You could see the Consumer Expectations Index, what they think of where the economy is going in the future. It's literally close to the lowest level of all time right now. And so we have this struggling consumer whose sentiment is poor, whose wages aren't keeping up with inflation, who is now spending less money, and we're combining this struggling consumer with a Federal Reserve that is still aggressively hiking interest rates and taking money out of the system. And this is the second monetary issue with the economy right now, is the fact that the money supply is contracting, bank deposits are going down, and loan growth is now going down. I mean, that's a massive double whammy. We have the consumer spending less, but now we have banks who are in the midst of a banking crisis experiencing a credit crunch and loaning less money into the economy, which you can see when we look at loan growth data from the Federal Reserve. They're showing that loan growth is now decelerated to 9% year over year from commercial banks. Now, that's still positive, everyone, but look at the big deceleration from the last couple months, and I suspect this loan growth is likely to continue to decelerate just as it did in 2008 before that crash, just as it did in 2000 before the dot-com bubble, just as it did in 1989 before the Gulf War recession, just as it did in 1979 before the double-digit recession, and so on. You can see very clearly when loan growth slows, it doesn't even need to go negative, it just needs to slow, our economy hits recession, these gray shaded bars. And so what about timing? How do you as a home buyer and investor combine all of these data points from different companies and different indices to understand timing and when you could reasonably expect to see the economy, housing market, and stock market turn south? Well, the consumer spending data is going to be something that transmutes its way into the economy pretty quickly. Less consumer spending is going to be felt by businesses very, very quickly. Meanwhile, a reduction in credit and loan availability is going to take longer, probably like 6 to 9 months to truly be felt, which leads me to believe that we are going to see meaningful softening in the labor market start to happen sometime this summer. Maybe by July or August, we're going to see the unemployment rate start to go up in America. Maybe by the fall, we're going to start to see a real panic potentially set into markets. Lastly, before signing off, I want to address a point that a lot of you have asked me about. You've asked me about low inventory on the housing market and the fact that home prices are now going back up this spring. And you're asking me, why is that happening when I predicted a housing crash to occur for the last 1.5 to 2 years? How could home prices be going back up in the spring? And the reason, number one, everyone, is because housing crashes take time to play out. Every housing downturn in US history pretty much takes 4 to 5 years from peak to trough. We're still in the first year of this downturn, so it's not uncommon to see the housing market have a rally. But really, the bigger issue is the fact that sellers on the US housing market simply aren't listing homes right now. You can see this especially in a state like California, where new seller listings onto the US housing market have dropped 34% year over year. Now, to be clear, this is not inventory. This is simply how many new listings came to market in the most recent month compared to a year ago. Other states with a big decline in listings include Nevada, Washington, Oregon, Illinois, Massachusetts, and Connecticut. Meanwhile, a lot of states in the South, such as Florida, Texas, and Oklahoma, and Kentucky, they don't have the same decline in listings. Inventory is still actually growing. And the main thing that's actually driving those differentials in sellers listing is mortgages. When I ran the data, I found that the more mortgages there were in a state overall, the more that new listings went down. You can see very clearly on this graph, a state like California, 70% of the owners have a mortgage, new listings are down 34%. Meanwhile, in Louisiana, only 53% of sellers have a mortgage, new listings are only down 12%. And the R squared here is 0.33, meaning this is a pretty robust relationship. Now, the reason for that is that a lot of people who have an existing mortgage, a 3% mortgage rate, which is a lot of people, they don't want to list their house and, buy a new house at a 6 or 6.5% mortgage rate. So these owners are just saying, I'm not going to list, which is lowering inventory. And that explanation kind of makes sense on the surface. However, when you think about it, it's actually kind of strange, everyone, because what we're saying here is that the more debt and the more interest payments there are in a housing market, the less selling pressure and less new listings there are. And that's ultimately something that's not going to sustain itself. Even if someone has a 3 to 4% mortgage rate, they are still paying more money to own their home than someone who owns their house free and clear. And we know that a lot of these people with 3 to 4% mortgage rates are still paying a very high payment. For instance, data from Fannie Mae shows that the debt to income ratio for FHA home buyers was up to 46% last year, even higher than the peak in 2008. So even though the mortgage rates were low for a while, the home prices were higher, mortgage amounts were higher, and people had more overall debt to begin with, meaning that they're still very burdened by their payments. Which means that as the economy turns south, as consumer spending goes down more and layoffs occur, a lot of these people are going to be forced to sell their homes. It's not going to be a discretionary choice about, I want to keep a 3.5% mortgage rate. When someone loses their job and runs out of money, it becomes a necessity to sell their house. And to understand this point better, I'm going to show you a poll that the real estate YouTuber Michael Bordonaro asked his subscribers on YouTube. He asked them, if you lost your job, would you be forced to sell your house after a few months of no work? Now, 63% people said, no, I have money saved for that. But 27% of people said, absolutely, they would have to sell their house within a couple months. What's wild is that the US housing market doesn't need 27% of people to sell for inventory to go up. They just need like 2 or 3% of people to sell. Right now, inventory is about 0.7% of total owned houses in America. So if just 1% of homeowners on the US housing market ran into some type of issue, inventory would nearly triple. But of course, that's tied to the overall economy. Are we going to see the recession get worse? Are we going to see meaningful increases in the unemployment rate? I think so, based on the data I showed you in this video, but we'll have to track it going forward. So if you want those updates, make sure to hit the subscribe button and let me know in the comment section below what you are seeing in your local economy and housing market.